In a shocking development, China's state-owned oil giants have halted their Russian oil purchases, sending shockwaves through the energy market. But why? It's all due to the sanctions imposed by the U.S. on Moscow's oil industry. The sanctions saga. The U.S. has taken a bold step, targeting Rosneft and Lukoil, Russia's oil powerhouses. This move has sent a clear message to Moscow, but it also has far-reaching consequences for the global oil trade. And here's where it gets controversial. The sanctions are causing a ripple effect, impacting not just Russia, but also its major trading partners. Impact on Russia's oil trade. Russia's oil exports are taking a hit, as its two largest customers, India and China, are reevaluating their imports. India, the top buyer of Russian seaborne oil, is set to drastically reduce its crude imports, leaving Russia with a significant demand drop. This leaves Moscow in a tight spot, scrambling to find new buyers and potentially facing a strain on its oil revenues. China's oil giants react. Chinese national oil companies, including PetroChina, Sinopec, CNOOC, and Shenhua Oil, have decided to temporarily halt their dealings in Russian seaborne oil. This decision is a direct response to the sanctions and the fear of being caught in the crossfire. With China importing around 1.4 million barrels of Russian oil daily by sea, this move is significant. However, estimates suggest that state refiners' purchases vary, with some sources claiming much higher volumes. The role of intermediaries. Interestingly, Rosneft and Lukoil primarily sell their oil to China through intermediaries, avoiding direct buyer interactions. This practice has raised eyebrows and sparked questions about the true extent of Russia's oil trade with China. But here's the twist. Independent refiners, despite the sanctions, are still keen on buying Russian oil, albeit with a temporary pause to assess the situation. Market dynamics and price hikes. The sanctions have already impacted oil prices. ESPO crude, for instance, saw a premium drop from $1.70 to $1 per barrel before the sanctions announcement. With China and India seeking alternative oil sources, the demand for non-sanctioned oil from the Middle East, Africa, and Latin America is expected to surge, driving up global prices. The big picture. This situation highlights the complex web of global energy trade and the impact of geopolitical tensions. As the world's top oil importers navigate these challenges, the energy market's future remains uncertain. Will this lead to a reshaping of global oil supply chains? And how will other countries respond to these developments? What do you think? Are these sanctions an effective strategy, or do they create more economic turmoil? Share your thoughts and let's explore the implications together.